This might sound absolutely crazy to a lot of people, but Microstrategy buying $2 billion of Bitcoin and not noticeably moving the price up is actually a good thing for the people out there that care about number go up in Bitcoin's price. And I'm going to explain why. First off though, my name's Forrest Hoddle. I'm on X and Nostr, and I'm a Bitcoin educator. And if you want to book a one-on-one consult with me to figure out how to secure your Bitcoin, Bitcoin basics, anything like that, you can check out the link in the description for that. So Bitcoin's price, of course, a lot of people want it to move when big money comes into it, but this is actually a really important thing that it doesn't move from big purchases like this or big selling, because it shows the liquidity of the market, and the liquidity of the market needs to be sufficient enough for bigger money to get involved. And right, this is directly out to the people that care about the number go up, right? So if we want the number to go up on a $2 trillion asset, we're going to need a lot of money put into it, a lot of value put into the market to push the price up. So let's look at some examples and what I'm talking about here. To sum it up though, large capital needs high liquidity because they need to make sure they have the ability to exit a position before they hold a position. This doesn't mean that they're going to just exit immediately after holding it, but they need the ability to. And an analogy here is if there's a problem in a crowded movie theater, there's one exit door and there ends up being a traffic jam at that point, and it becomes very difficult to get out of that movie theater. So it's not a good place to be stuck in that movie theater. And right, this is an analogy to the trade. If somebody makes a big purchase and the liquidity dries up in the market and they are ready to exit that position, or they need to rebalance, or there's all sorts of reasons, right? They might want to take profits because they're losing on a different trade or any sort of thing like that. But they can't exit at a reasonable price, or when they start to exit, it actually creates slippage and the price of the asset is drastically affected. This is really not an ideal situation for them. And you can see this, very illiquid markets are, small cap stocks or options, right? Where there's a big difference between the bid and ask. So there might be a lot more people wanting to buy and a lot fewer people wanting to sell, or vice versa. And this will create a liquid or a large spread between bid and ask, or buy and sell price. If you look on certain stocks, you might see multiple cents difference, right? And if it's a big purchase, that might make a big difference between the bid and ask or the liquidity of the market. So who are the big institutions that are evaluating Bitcoin as a liquid market? Well, some of them might be like hedge funds, like BlackRock has a hedge fund division, Bridgewater, Citadel. For example, Citadel has, in 2023, they have assets under management of $63 billion. So they hold a lot of assets. Mutual funds, which are typically an actively managed, diversified portfolio that endowments and pension funds buy. This is another big source of money. And then behind that, right, who are the endowments? Endowments might be for like a university like Harvard, and pension funds. Here's an example. The public pension fund of the California Public Employees Retirement System, or CalPERS for short, manages over $500 billion in assets as of 2023. So they probably have a lot more now. That's 2 years old, that data. And it goes to show just how big of an investment portfolio some of these huge, large money institutions have. So there's also investment banks and asset managers like Goldman Sachs, JP Morgan, State Street. JP Morgan, for instance, it manages over $3 trillion, so 6 times as much as the California Public Employee Retirement System. $3 trillion in assets through its asset management division. So these large institutions need an investment vehicle that is highly liquid before taking a position, because their trades will involve massive capital. If they just put 1%, right, a 1% allocation, which is what Larry Fink of BlackRock is calling for as an investment, 1 to 2%. Well, that's a huge position for an asset manager that manages $3 trillion of assets. That's going to be a huge amount of assets. And if that's going into Bitcoin, right, can Bitcoin's liquidity handle it? And right now we have large capital flowing into Bitcoin. Like I said, we had, I think it was $1.9 billion of buys in 1 week from Strategy last week. Is that big enough? Is that a proof enough of liquidity? I think for some players it is. For others, maybe they need to wait until Bitcoin's market cap and liquidity becomes big enough to be able to handle that much cash and value put into the Bitcoin network. All right, so liquidity, again, I'll just redefine this. It's the ease with which an asset can be converted into cash without affecting its market price. Really, really simple. And we can see, again, $1.9 billion. And did we see the price go up? I mean, we did. I'm sure that affected the price, but the price was all over the place. The price was acting as normal for Bitcoin, and actually the volatility was a little less, and all sorts of things like that. So it wasn't a massive spike from this 1.9 billion, which is what I think a lot of people on X really hope for, is that Saylor is propping up the market with all of the Bitcoin buys. And what we've seen is that isn't necessarily true. And this is a pretty liquid market with a decent market cap. And 2 billion, roughly 2 billion, isn't showing any noticeable signs. And that will allow more people, right? Because literally these big money players are not able to mess around with small illiquid markets. Maybe they have a subsection for that kind of stuff, but it's minuscule compared to their ability to buy Apple, buy the S&P, buy QQQ, large liquid funds, and even bonds, right? The bond market is even bigger than the equity market. So there's a lot of liquidity within bonds as well. And so that is where they're messing around. That's where they're playing. And Bitcoin is just small potatoes to them, and they need proof of liquidity before they can even open up a sizable position in that market. So again, they want to be able to sell their holdings when needed, to lock in profits, cut losses, rebalance portfolios, and they want to be able to do that without causing a market crash or getting stuck in the position. That can happen, right? They can literally get stuck in a position. So again, here's this definition. I've already explained this, but in a liquid market, the bid-ask spread, the difference between what buyers are willing to pay and what sellers are asking, is narrow. High liquidity ensures they can exit at a price close to market rate. So it's not going to drastically affect it. All right, so here's some real world examples that I got Grok to pull up for me. So if CalPERS wanted to allocate 10% of its portfolio to US equities, that would be $50 billion because there are $500 billion assets under management. The $40 trillion S&P market can easily absorb that without CalPERS owning a disproportionate share. So they would actually only own 0.125%. So that's the other thing too, is they don't want to create a massive centralization of ownership either in a smaller market, because then they have to basically become more directly connected to the companies that they're investing in. Some investors want that, but other ones just want to passively be able to invest and have these companies work for them and create cash flows and future cash flows. So let's take a look at the bond market here. The global bond market is even larger than equities, valued at over 130 trillion as of 2023. This includes government bonds, corporate bonds, and municipal bonds. This is all debt instruments. So an asset manager like JP Morgan Managing 3 trillion might allocate 500 billion to bonds. The $130 trillion bond market can handle this scale, allowing them to invest in highly liquid segments like US Treasuries, which is a $25 trillion market cap, or investment grade corporate bonds. So now we get into some things that are similar in scale to Bitcoin, or maybe even crypto. Crypto, besides Bitcoin, is smaller market cap, so it's even a more illiquid market, and less likely to get a lot of big money into it. So this is the alternative markets or alternative investments. So private equity, a lot of private equity dabbles in this because they can try to see outsized returns and take on more risk. Market size. So the private equity market was valued at 4.5 trillion. So it's more than double Bitcoin's already. And why it matters, the size of it. So endowments like Harvard, which they manage $50 billion, often allocate 20 to 30% of that to alternatives, so 10 to 15 billion. So the 4 trillion hedge fund market can accommodate this, but liquidity is a bigger concern in alternatives. And with private equity, the way they deal with this is they often have lockup periods or less frequent trading. So some sort of restrictions that encourage lockup until there are liquidity, or when the lockups start to come due, it's certain portions that they're able to sell, and this will be okay for the market, and the market will understand that this is all happening. They can see this ahead of time. The lockups are public knowledge for these private equity investors. And this allows for some liquidity and doesn't overwhelm the rather illiquid market. That 4.5 trillion is spread up through a bunch of different private equity companies. So Bitcoin is bigger than that, but you can see that with these smaller equity positions, that liquidity does become a concern, and they have restrictions on that. And as we know, Bitcoin is unrestricted, it's global, it trades 24/7, so that isn't an option. So the only option is for the market to get bigger before bigger money can go into it. We cannot restrict Bitcoin. So this part I thought was really interesting. This is general liquidity thresholds for institutions. So let's talk about position size versus market depth. So as a rule of thumb, institutions prefer their position size to be less than 1 to 2% of the asset's daily trading volume or market cap to avoid price impact. For example, a $1 billion position in a stock requires a trading volume of 50 to 100 billion. There's only certain markets that are really going to have that much trading volume, right? So that is why MSTR is very interesting. That's why Bitcoin is very interesting. There's a lot of trading volume relative to market size because there's so much activity and so much interest in the asset as a trading instrument, which allows for more liquidity as well. So market cap minimum. Institutions typically target markets or assets with at least 10 to 20 billion in market cap to ensure that they can take meaningful positions without dominating the market. Let's summarize all this, and it's all of this is about risk management. So they need to be able to execute large trades without significantly moving market price, ensure they can exit positions quickly at a fair price, especially during market stress, manage risk by maintaining flexibility to adjust their portfolio, and avoid creating volatility that could destabilize the market and erode confidence. This is why I believe that strategy being an example of being able to buy a huge amount of Bitcoin and pump a lot of value into the market without drastically affecting the price is a very good sign of big money coming in and pushing the price of Bitcoin up for everyone that cares about number go up with Bitcoin. For me, I care about freedom go up. Number go up is just a reflection of the interest and where we are in the stage of Bitcoin adoption. And I will continue caring about all aspects of Bitcoin and sharing them here on this channel. Now, if you want to get yourself some Bitcoin, I recommend checking out Bitcoin Well, which is a non-custodial exchange, which means when you send them dollars, they send you Bitcoin directly to your cold storage. You don't open yourself up to third-party risk. And if you use my code in the description, you'll get some free Bitcoin on sign up. Can't beat free Bitcoin. And if you want to preserve your Bitcoin for generations to come, I recommend checking out Stamp Seed's Titanium Seed Plate Kit and using my code BTC not crypto 15. Check out the link in the description as well. And of course, a reminder, if you need some help with Bitcoin basics, whatever, you can book me for a consult, and the link is in the description as well. Thanks everybody for watching. And if you want to continue watching, there's a playlist and some videos popping up all over the screen here. So thanks everybody, and we'll see you on the next episode of Bitcoin Not Crypto.